In the final quarter of 2023, Israel experienced a significant downturn in its output, marking the first contraction in nearly 2 years. This decline was primarily attributed to the toll taken on the economy by the ongoing war with Hamas. According to Israel's Central Bureau of Statistics, the gross domestic product, GDP, plummeted by 19.4% on an annualized basis compared to the previous quarter, which had seen a modest growth of 1.8%. The severity of the decline was exacerbated by a 26.9% drop in private consumption, driven by a loss of confidence following the October 7th attacks, leading households to reduce their spending. Additionally, fixed investment by businesses saw a staggering decrease of 67.8%, largely due to a slowdown in residential building resulting from military call-ups and a reduction in Palestinian workers. Liam Peach, a senior emerging markets economist at Capital Economics, remarked that although a recovery appears imminent in the first quarter, the GDP growth for the entirety of 2024 is expected to be one of the weakest on record. Prior to the outbreak of the conflict, Israel's economy had been robust, achieving a growth rate of 6.5% in 2022. The government had also managed to decrease the debt-to-GDP ratio to 61%, down from 71% during the pandemic, a significantly lower level compared to other countries like the United States and the United Kingdom. However, the ongoing conflict has posed challenges to the strength of the economy and strained government finances. Year-over-year inflation slowed to 2.6% in January from 3% in December, indicating a potential weakening of economic activity. Moody's has projected a substantial increase in Israel's public debt burden, with defense spending expected to nearly double its 2022 level by the end of the year. In response to the conflict, the government has implemented measures such as subsidizing housing for Israelis displaced from areas bordering Gaza and Lebanon, as well as providing financial assistance to affected workers and companies. The workforce saw a decline of approximately 7% with the mobilization of over 300,000 military reservists, although there are signs of recovery as reservists are being released from duty and schools have resumed, bringing the labor force closer to pre-conflict levels. The recovery of the labor force is particularly crucial for Israel's tech sector, which accounts for 18% of the GDP, half of the country's exports, and 30% of tax revenue. Despite challenges, the tech industry has demonstrated resilience, with demand for its services holding up well, especially from international clients. Major tech companies continue to operate in Israel, and there are indications of potential fundraising recovery, with interest from global investors despite logistical difficulties. In a notable show of confidence, Intel reaffirmed its commitment to building a chip-making factory in southern Israel, injecting $25 billion into the project. Additionally, there are signs that fundraising activities may rebound, as indicated by planned visits from Korean investors. In conclusion, Israel's economy faced a significant setback in the final quarter of 2023 due to the impact of the conflict with Hamas. While challenges persist, there are signs of resilience, particularly in the tech sector, and efforts are underway to support recovery and mitigate the economic impact of the ongoing conflict.